insured to pay the claim. So Fred got the settlement check. Fred still got the settlement check, however many years later, because that's who, good luck getting it from Fred. Our client owned the property at that point, and I wasn't the client then, as I said, so they're still looking for Fred to get that money. So that's your first challenge. Second challenge is, let's just say, instead of a $4,000 fire, it's a $40,000 fire. First thing the insurance company's going to do is go back to the policy. They're going to go to the contract. They're going to find out who owns the property. Because what's that insurance company trying to do? Not pay the claim is what they're trying to do. Right? So the $4,000 fire, yeah, they're probably just going to throw up the stack and get it done. The $40,000 fire, they're going to find out that Fred no longer owns the property. Well, if Fred no longer owns the property and he doesn't live there, and it's written on a homeowner's insurance form, technically it's an incorrect form. The insurance company can pull the old wash their hands or battle a little bit and not want to pay the claim. So the point is, do it the right way. What we've always done and suggested in Knockwood, and 1,000 times of doing this, is we've never had a loan call because the insurance changed. You buy the landlord type policy because typically Fred isn't in there anymore, it's somebody else. You name you or your entity as the first named insured, as they should be. Fred is named as an additional insured. Because that additional insured endorsement is doing nothing but giving Fred liability protection, and it usually doesn't cost you anything. Doesn't mean that when a claim occurs, Fred's going to be on that claims check. That would be a lost payee. Fred's not a lost payee, he's just an additional insured from the liability side of things. Mortgage companies named as they should be with their mortgagee clause, their loan number, and everything there. The reason we named Fred there, not so much to trick the mortgage company, but the few times that the mortgage company says, well, what's going on here? Well, there's you or your new entity as the first named insured. There's the mortgage company on the document as they should be with the correct loan number and such. And there's Fred. What's that $10 an hour mortgage person want to see? They want to see Fred's name, they want to see their loan number and all that. They see Fred's name, it's in the file, and that's the end of it.
So Fred is protected for liability. No, not it needs to be, but anybody who's named as additionally insured, they...
Yeah, Fred would garner liability protection by being named as an additional
insured. They're not lost payee.
They're not lost payee from the property side. That's the delineation between the two.
Now this is on the subject to?
Yeah, subject or lease option, it's happened too, but lease options get a little more specific, if it's a good word, personal if you want to put it that way.
Because it seems like on subject to, the mortgage company, if it was escrowed, in the mortgage, it would be a tricky situation to get in there and change that from the existing policy to something else where you're the...
It is, but what we, at least in our system, and this is getting more or less dealing with our company and how we handle it, is even if it's midterm, you bought that property from Fred midterm. What I mean by midterm is Fred's policy runs January to January, and you buy it in July.
Okay.
Now there's a homeowner's premium that was already paid in January.
Okay.
So when you cancel that policy, what I would suggest is, whether it be through your power of attorney with your deal with Fred or whatever, typically there's not a lot of premium in there. If it's Fred's house at $100,000 and there's $800 of premium and it's midterm, there's $400 coming back. Mortgage companies will garner, they will entertain that coverage change midterm.
Just like they would a check that wasn't Fred's check anymore. When you start sending checks into the mortgage company, they don't care that as long as they get paid.
As long as you're getting paid.
Okay, gotcha.
I mean, Knockwood, we all do on sale clauses there back in the 70s and all that with the mortgage rates. But right now, again, I'm speaking as Tim the investor, not Tim the agent. But
gotcha.
If you bring a mortgage up to speed and it's paid on time, you're never going to get a mortgage.
They're happy. Okay.
It's not happening.
Gotcha.
That's just me, the investor. But yeah, you get into lease options, and we get those calls quite a bit too. Hey, I'm buying this property lease option. I've got a tenant in there, and I'm buying it from Joe. How do I protect myself? Well, it really depends on what you've got in it, and that's what I was alluding to. If your spread is significant enough that if the place burns, because Joe should have a landlord type policy on it. You're just sandwiched in the middle, so to speak. So the point is, if your spread is, let's say, $300 a month, and you want to protect that $300 a month, then you can be named on Joe's policy as a lost payee relative to just that loss of rents exposure. Now you're getting a little savvy, and frankly, if I'm the investor, not the agent speaking to you, I'm not even going to bother with it. All I want to be named on his policy is an additional insured. Because if that tenant slips and falls or his dog bites a neighbor kid, I want to make sure I'm protected over here liability-wise. I don't own it, but I've got that option on it. Does that make sense?
Yep.
So it's really subject to what type of exposure. Now let's say you took That lease option, you dump $30,000 into the property to get it up to speed. Now you've got an exposure. Now you've got some financial, call it what it is, you got some money hanging out there. That's where you may want to be a lost payee subject to that $30,000 investment. Or in your agreement, you do have an insurable interest. You can take that insurance over. If it's me and I've got that much money in a property, I'm having Joe, he can cancel his policy because I'm getting insurance on it. I want to be that first name insured. And I'll protect Joe on the other side of it as a lost pay, almost as a mortgagee to a certain extent. So again, that's what I meant. There's no one magic answer to a lease option. It's very relative to the deal itself and how you insure it.
That's usually what you would want to do if you were going in and having some cash.
Take it, yeah, take it. You mean take the insurance over? Because the first name insured is the entity that is the primary beneficiary of that policy. Period. They're co-insureds, they're co-named insured, they're additional insureds, they're lost pays, they're different terminology, but each of those terminologies mean a lot. And who gets paid when the what hits the fan. So again, it'd be nice to have one check mark done, but in a lease option deal, it's a little bit different on how you address the appropriate insureds. That's that guy, he still can't figure it out right there. All right, again, these are no necessary orders, I stated, but buying a property in your personal name and using your homeowner's policy is fine. Anybody ever bought, when you remember buying that first rental, call up the insurance agent, and the insurance agent says, well, that's fine, we'll put it on this dwelling fire policy, we'll take your homeowner's liability and we'll extend it to that rental for you. Well, my point is, not just from an insurance agent's perspective, but from an investor's perspective, I want to segregate anything that's business related from anything that's personal related. Take it all the way back to the analogy of the castle walls and the moat. I want my stuff on the inside of those walls. I want those exposures that are really business related. And if you're in this room and those investment properties that you're putting money into aren't a business, then you aren't paying attention is my attitude. So anything that you do relative to your insurance on your investment properties to me should be completely separate from your personal. People say, yeah, but you never want to go to commercial insurance because it's more expensive. Well, if you email me, I'll send you a list of about 15 reasons why that commercial policy is better. Not just when it comes to the expense, because there's ways to offset that with programs as we've put together, higher deductibles, those types of things. But the point is, keep your stuff away from your business stuff, if that makes any sense. That's my dog right there. No. That's what just alluded to this. The person with a dwelling fire is sufficient is cheap to cover my non-owner occupied rental. A personal lines policy, such as a dwelling fire policy, is fine if, give you for instance, we had a property on a lake in Tennessee, down on Norris Lake, no relation to us at least. And we used it personally. We did rent it out, but we only rented it out to family members. So in that case, not to contradict myself, there were some closely held situations there. We had to control the property. We knew who was in there. It was more of a vacation home than it was a rental, so to speak. So we put it on dwelling fire, a secondary residence policy, and we did in fact extend our homeowner's liability to that. A few years after we bought it, we decided we weren't using it enough, but we wanted to rent it out. So we put it on the rental program with the resort area down there in Deerfield, where it is in Tennessee. And then I took it off of that personal lines policy and put it on a commercial policy because to me, we didn't have that control we had before. So even though it's cheap, you got to know what you're protecting. And if it's protecting your exposure that to me should be commercial in nature, then protect it the right way. At the same time, in dwelling fire, even if you decide, well, Norris, sound all right, but I just need to save the money right now. One quick example of a coverage that doesn't exist on a dwelling policy that does exist on a commercial lines form, I shouldn't say a coverage, but really an exclusion, is a pollution exclusion. I know at face value you might think, what's pollution have to do with my rental properties? Well, to the insurance industry, the definition of a pollutant encompasses a gas. Well, what's that gas from a furnace that comes out that does damage and physical bodily harm? Carbon monoxide. So the universal pollution exclusion that exists in most dwelling fire policies, God forbid one of your tenants claims to get sick or does get sick, not only will your policy won't protect you, it won't hire the attorney to defend you either on a dwelling fire policy. A commercial policy will. Mold depends on the coverage, depends on the policy, depends on the company. Some companies limit, like one of the programs we have is excludes mold altogether. One program limits it to 15,000. Mold's kind of like what asbestos was 20 years ago.